Let's talk to another strategist. He's Chris Hyzy. He's the CIO of Merrill and Bank of America Private Bank. He joins us now. He's our headliner today. You disagree with anything you heard?
No, I don't think. How can you? I mean, I think it's so well said. Far be it for me to poke holes in any of those debates or dialogue or arguments. I think it's spot on. The one thing I would say is, Scott, you talked about, is the market trying to price this in? And we know this, like you said. What we don't know is the magnitude of this, the magnitude of earnings decline. It's pretty much baked into the cake for next year. Earnings are going to decline. You know, Josh talked about it, Bryn talked about it, Sarat talked about it. Steve obviously covers a lot of this. From my perspective, it's really important to understand the magnitude. And we don't have enough information yet to understand the magnitude. All we can know is the fact that balance sheet contraction mixed with higher cost of capital, mixed ultimately with great unknowns around the world, and the fact that multiples are coming down and we don't know the magnitude of all this means it's time for defense. And that's okay. I think Bryn talked about that. And Josh talked about it. You know, it's okay to play defense until you get through, according to what the Fed said. I mean, the Fed used some very forceful words. They said, we're okay with some pain, or we're going to see some pain. We're going to be forceful. They're talked about strongly caution. These are very, very strong words, and that means higher for longer. And if anybody knows anything about investing, if it's higher for longer, you really should be looking at high free cash flow areas, pricing power areas, demand that's going to hold up relative to supply.
Unless their words end up being stronger than their actions, right? That's part of what the Fed does too, right? Maybe it's just a big, healthy dose of jawboning from Powell. He needs financial conditions to tighten, which they haven't, really. In fact, you could make a big argument that they loosened since the last speech at the, not Jackson Hole, but the press conference. How do you factor it? And by the way, if a bull was on the set today, Jim Lebenthal was sitting right here, he'd say, okay, that's great. Nothing new. We know all of this, and the economy is strong enough to withstand all of it, as evidenced by even the data that came out today. So how do you counter that?
Well, we have to parse them what strength means in the economy. You know, a lot of it is price hikes, or at least inflationary driven growth. If you're going to pull liquidity out of the markets, then there's less liquidity to do things with. And if you're of low quality nature, you're no longer supported by the liquidity. So by and large, the amount of people adding to growth in the economy is coming down. Can we stabilize? Absolutely. This is a very resilient corporate America and a very resilient economy overall. But I think the big question is can it support? Can higher interest rates support the multiples that we're used to? They probably were more likely normalized on a lower earnings number. So the market needs to reset a little bit and then kickstart a whole new cycle, which, let's be honest here, you get through these next 6-9 months of a reset, Scott, we're setting ourselves up for the next 3, 5, 7, 10 years of most likely the greatest revolution of automation we've ever seen. And if we have a low labor supply, the only thing corporate America can do is create labor supply out of automation, which should kickstart some productivity and gain a whole new profit cycle. So we're bullish in the long term, want to play defense in the short term. And yes, you're right. Maybe their words are stronger than their actions, but at this point, that's not a high probability.